to say growth eats cash, right? Like that can happen. But I think with proper planning and actually knowing the health of your business, knowing financially where you stand, it's far less painful and it's more anticipated and we're more prepared for it. I think all the way down to our bankers, they like seeing that.
Welcome to the Roots of Success, the premier landscapers podcast that brings you the latest tips and strategies for successful landscape business. I'm Jim Callai, one of the principals and coaches of McFarland Stanford. Jason New and I started McFarland Stanford to coach landscape businesses after years in the industry ourselves. Now, more than 10 years since we began, McFarland has a deep bench of coaches and subject matter experts who work with our clients on very specific issues of business. Whether you're struggling with people, profits, or just day-to-day challenges, our coaches and guests have the real-world experience and practical advice to help you build a thriving and profitable landscape business.
Good afternoon. Welcome to the most recent episode of Roots of Success. I am pleased to be able to guest host this week. My name is Jennifer Murray. I'm part of the McFarland Stanford team here. I focus primarily on valuations, on financial health checkups, on helping companies think about buying and selling other companies. And I'm also an ACE peer group facilitator, a recovering investment banker and private equity professional, kind of a self-professed number geek. And I'm thrilled to be here with one of my very favorite ACE peer group members, Jonathan Peterson at Summit Landscape. Jonathan, why don't you tell us a little bit about you and your company?
Yeah, absolutely. Thank you for having me. It's a lot of fun. Looking forward to it. So I guess a little bit about us. We're based out of the San Antonio, Texas area in South Texas. Been in the industry for a while, kind of grown up in it. Got a really great team that I'm really, really proud of. I think what probably makes us unique and sets us apart a little bit is our people and how we put focus on them. It's not really about landscape. It's about our people and what we do here. So we understand the gravity of that, of the importance of us doing a great job on the support team side to support the field team that we have here and make sure that they have what they need. So that kind of ties into the financial health checkup side, the valuation side, of realizing how important that is in order for us to impact the lives that we are within our team here. Right now, we're about 65 team members this year. In our peak season, we primarily have shifted towards commercial, whether that be commercial installation work or commercial maintenance. This year, we'll do about $9 million in revenue. And really, we're just blessed with the great year that we have here, kind of growing like crazy over the last 6 months to a year. With some really unique projects. So really just enjoying that and kind of along for the ride, if that makes sense.
Excellent. It's been so exciting to see how your company has grown and evolved over the last few years. Excited to talk to you today. Our primary focus today is going to be helping folks understand the importance of financial health and understanding your numbers and how that's more than just top and bottom line. We'll talk a little bit about how financial health impacts the value of your firm and what it's worth. And then hopefully we'll close out with a little bit of a understanding of how your company's value can lead to better outcomes, whether that's for your key employees, you as an owner, better dialogues with your lenders, and just overall kind of peace of mind. So maybe let's just kind of start with the financial health assessment piece of this, Jonathan. I think a lot of owners kind of struggle with digging into their numbers because they're afraid of what they might find. And it can be overwhelming. You'd rather not know how potentially bad things are or good. But I tend to think that, it's better to know so you can fix it than not. We've worked together on, I think, 3 financial health assessments over the past few years. Maybe can you describe for me kind of how that process was for you, what your expectations were going into it, and kind of what you got out of it?
Right. Yeah. I mean, you hit it nail on the head. I think a lot of times in the construction and landscape industry, we don't exactly dig into the numbers how we should. And we just look at it as, hey, we got work, we're busy, we're getting stuff done. So that must mean things are good. And I think once you reach a certain size of company, which we definitely hit that point, I'm going, hold on. Why does cash feel a little weird right now? Like right now it's great. Why is it great? Right now it's terrible. Why is it terrible? So I think getting that back end data and knowledge to better understand our numbers and really, from my perspective, I wanted to be a great banking client. So that was a huge focus for me to realize, how do we be the best client so that the banks are essentially fighting to work with us? What do we do so that we understand our numbers maybe even better than they do? So from the financial health checkup side, I mean, we get deep into it, right? It's not really what I would call into the weeds, but we're definitely digging deep into absolutely everything from cash flow, collections, right? AP, what does that look like? Why do we feel this pinch that we feel, or why don't we feel a pinch right now? So it is a detailed process. I think it was 3 years, if that's right, 3 or 4 years that we did it in a row there, just to better understand. And of course, that was through wild times of COVID, kind of the beginning of that happening, and PPP funds, and then, rapid growth in the outdoor sector kind of as a whole, as people are at home. So it was really just a unique time in the industry, a unique time to be in business. And I think digging into the details of the financial health checkup really kind of helped me to better understand why we were feeling what we were feeling, and get to where, as we continue to grow as a company, I could anticipate what was coming next, start to have a better idea of what this is going to feel like, what we should be experiencing, and more often than that, even how we should prepare for it.
That's great. And I think that the thing about financial health is that it's not the same every year or every season, right? I mean, some years you
Absolutely.
have great cash flow and kind of modest top line growth. Sometimes you have not so great cash flow and your revenue line is killing it, and you're kind of scratching your head, saying, "Why don't I have more money?" So kind of
Right.
that granular focus on just sources and uses of cash. Where did it come from? What did we do with it? Are we happy with what we did with it? Do we want to do that with next year? Um, as you said, thinking kind of strategically. So knowing what you know about your cash flow, how do you think about your budget and the timing of your expenses? When do you want to spend money? Because if cash is going to get tight, maybe that's not a great time to come home with a new truck. Although some would say it's never a bad time to come home with a new good truck. It's just, but
Fair.
just kind of understanding timing, right?
I
And
mean,
then blind
absolutely. In
spots.
our industry, especially, like, we're such a seasonal industry. Even though we're in the southern U.S. and South Texas, right, we're blessed to be able to mow nearly year round. So that's a blessing in itself. But there is still seasonality. And I think that really helped me better understand when we should be buying things, when we should not be buying things, when to anticipate cash being a little bit tighter. And even on the other end, we've grown so much over the last year, 18 months, that the knowledge I gained doing those financial health checkups for a few years in a row, a few years ago, has really helped prepare us now for this more rapid growth we're experiencing. And, I have to say, growth eats cash, right? Like, that can happen.
Yeah.
But I think with proper planning and actually knowing the health of your business, knowing financially where you stand, it's far less painful and it's more anticipated, and we're more prepared for it. I think all the way down to our bankers, they like seeing that.
Oh, absolutely. Bankers love folks to know their numbers. Speaking from experience, that's a huge, huge source of comfort to your potential lenders. So, I mean, I would just submit that knowing your numbers, even if the news is not uniformly positive, and we all have things we can work on, is better than not knowing what's going on with your business. I think it will give, generally owners a sense of greater calm about where they need to focus, and probably a little more intentionality about kind of where they're going to really kind of drill in with their team and with their finances over the next 12 months. So,
Oh, for
any
sure.
other
Yeah.
thoughts on that?
The comfort that comes from it is next level.
Um, well, I guess this probably is a good pivot to the relationship with bankers conversation. You've had a number of dialogues over the last 12 to 18 months with lenders. You and I have talked in the past about kind of right sizing lines of credit and kind of thinking about how much liquidity is enough liquidity. In my experience, clean financials are job number one for a banker, is to make sure that the numbers that they're evaluating make sense, kind of hang together. And cash flow consistency and debt coverage is the name of the lenders. Would you agree?
Oh, for sure. Yeah. I can't tell you how many conversations you and I have had with that, and how many, just in peer group meetings that we dig into that. And really, that I'm just asked our bankers straight up, like, what's their tolerance? What do they want to see? I love, that's probably my favorite term in the financial world, right? Is liquidity. That's kind of what I want to know. Like, where are we at? What do we have on hand? Is that really what we have on hand, or what's based on line of credit? Is that AR based? Is it, how are we getting to where we're at from a liquidity standpoint? So that's, everybody has their different kind of tolerance for risk. For me, it's a liquidity thing. That's what I want to know. Where are we at with this? Where are we at with funds on hand? How long can we go? What are our burn months? What are our earn months? And
Right.
really anticipating that. And I think our banking relationships, as I work to not really write those relationships, but kind of reset expectations of what I expect out of my banker and what my banker expects out of me, them knowing that I have such a focus on liquidity and what we actually have sitting in the bank. My goodness, I can just feel like the tension being pulled out of the room. And from their perspective, they're looking at it like, man, okay, they've got it. They understand. They know I'm not even going to submit for a loan that I don't think we should have. And how often as business owners, we go, well, I need that piece of equipment. Do we really need that? Where are we at financially? Is that the right thing to do right now? Or should we delay that a little bit? Should we rent for a little bit? How should we handle the situation? Kind of making that a group discussion, which is really what I try to do with our leadership team. They know we want 10% liquidity sitting in the business at all times. That's my number. It may be right. It may be wrong, but it works for us. So I think it's so important for people to kind of figure out where they want to be liquidity wise, and where their banks want to see them liquidity wise.
Great point. Great point. And I think it's worth noting bankers come at their business a little bit differently than I think most landscaping professionals do. Banks are so risk averse. They are less focused on an opportunity to make money and more focused on not making a decision that will be fired. So it's a totally different mindset. I mean, they're kind of avoiding mistakes versus seizing opportunities. That's just the institutional kind of mindset of banks. And so kind of understanding that when you have those dialogues is super critical. And I also think something that folks may not be aware of is that there are different kinds of lenders. Some banks are focused on cash flow, what that cash flow is, what that cash flow coverage is. That's one type of lender. Another type of lender is asset-based. So if you want to buy a truck, the truck is worth 80 grand, we'll loan you 60 grand. And so it's just a totally different mindset. So understanding that going in can help you be more patient with your banker, and better prepared for those dialogues, because you almost have to help them understand that you are on top of the risk of the situation. Yes. So they can breathe a little easier.
Yes. I mean, that I'm probably on the side that I'm so honest and transparent with our bankers, even to the point that they all know of each other on a first name basis. So that's something for me that I tell them, like, hey, I'm not only banking with you. I've got 3 different banks that I work with. Here's the relationship. Here's where each of you have your piece, right? I need y'all to each perform in your piece and I'll perform in mine. So getting them to understand, like you said, some of these banks don't want to write facility notes. Other ones want to write equipment notes. So it's figuring out their appetite, like you said, and really just communicating that incredibly well and very clearly, saying this is what's coming. That's something I did early on this year, was say, here's what I expect by the month going into this year, when we will be acquiring, what we will be acquiring. Let's get all this knotted out now in December, January. So the 26th is smooth. So you're expecting that call from me in May. You know what I'm going to be asking for, and we're already prepared for it. So suddenly this is a much faster and much smoother process.
Sounds like a dream client to me from a banker's perspective.
Well, I figure
I think it's also good.
Let's hope. I want the banks to like us.
Yeah. And two, having that kind of natural competition among the bank group, and
yes.
Kind of the comfort, again, as a risk-averse banker, if 3 other banks like this company, they must be on top of their stuff. And so that kind of adds a little bit of comfort to them that, your risk profile is managed. And I think the other thing that's great about information sharing is banks don't expect you to have an up year every year.
Correct.
They want you to be open about your challenges. And then, kind of having, experience with that and managing through it, I think is a huge plus for you as a borrower.
Oh, for sure. I mean, I can't stress how important that is. That's something that, I recently went through a buyout this last year, bought out my partner his shares in the company. And that was something that I was so clear with all the banks about. Here's what's happening. Here's why I'm doing it. Here's exactly what I'm paying. Here's where the funding's coming from. And piecing all that together that, as soon as those things were done, because I was so transparent about it, I mean, literally the next day, my phone's blowing up. All right, what are we doing? Let's go. We're ready to move. So I think just that honesty is incredibly important. Even like you said, I don't expect us to have up years every year. And we're not going to. I mean, you're going to have years that, they're just tough. And there's just no other way of putting it. But I think if the relationship is strong enough, which those relationships have to be backed with clean financials, clear awareness of what you're dealing with, and true honesty with your banker, the relationship's going to be good. So I think we're able to be transparent on those years that saying, hey, it's just rough right now. But I think just as much as you're transparent on the years that are going to be rough or the next quarter that's going to be rough, I try to give them a heads up on the next quarter that's going to be great. So that way they know that it's like, if Jonathan's saying it's going to be rough this next quarter, he means it. It's going to be rough. If I say it's going to be great this next quarter, it better be great. So that they can learn to take what I had seriously, understand it, and go, yep, we're good. You warned us about this, or hey, way to go. Y'all are killing it. This is awesome. We're glad to be a part of it. So I think that honesty is very, very important.
And to have those types of lending partnerships versus, a hostile relationship, or, a lot of ACE peer group members will say, well, I don't really need to borrow. You don't need to borrow until you need to borrow. And so kind of establishing those relationships really before you need them is critical, so that you don't find yourself flat-footed introducing yourself. Hey, my name is Jonathan. I'd like to borrow $2 million. That's going to be a much harder conversation than what you just described, with a multi-year process and lots of communication and openness about, what's working and, kind of where you're headed.
Oh, absolutely. I mean, it's kind of the whole get it while the getting's good, right? You got to go to the bank and say, hey, look, we're great right now. I need to establish a higher line. Like, what are we going to do to bump this to the level we want it to be, to lock it in place then? And then I think, like you said, sometimes you don't need to, but I'm on the other side of that. If I'm going to have a line of credit in place, I'm going to hit that thing once a month. Whether I need it or not, that's probably overkill, but I'm going to hit it once a month, whether we need it or not, draw on it, and 2 or 3 days later, pay it back. And I'm going to also give them a clear, logical reason as to why we did that. Say, hey, it's a cover payroll period, whatever it may be, a large project. I think using those things is incredibly important, because if you don't use it, you're going to lose it. I think we've got to be smart with that.
Absolutely. I've heard of clients who go to use their line of credit only to find out that it's canceled because they hadn't used it in the last 18 months. Or, your new finance person doesn't know how to draw on the line of credit, and you're finding that out on Friday afternoon. That's a tough kind of series of events. So, kind of practice, whether it's for 2 days or 3 days. I love once a month as a frequency, just so that you're kind of keeping that muscle memory active and making sure that your bankers kind of realize that the line of credit is important to you, even if you're not using it as a regular funding source.
Absolutely. And I think even on the other end is I always make sure we have different types of lines, whether that's cash back lines. I think those can be appropriate if the rates work in your favor. Accounts receivable back lines, whatever, or just standalone lines. We have one of each is our goal, and fluctuate between those. And we're clear on what we use each of those for, all the way to our equipment guidance line, making sure that we're buying the appropriate pieces of equipment on that and actually using that. Otherwise, good luck getting it next year when you have an aging fleet, something that can be replaced.
Absolutely. And as you probably have experienced, banks sometimes change their appetite for lending as well. And so
yes,
not having all your eggs in one lending basket is a pretty good strategy.
Absolutely. Yes, ma'am.
Well, let's talk a little bit about how financial health and kind of understanding your numbers relates to value. I work with a lot of companies who, will say, Jen, I don't really need to understand my value because I'm not going to sell anytime soon. And my response to that is understanding what your company is worth is helpful on so many different different fronts, whether it's in the lending relationships that we just described. We're building a 5-year strategic plan to kind of figure out how you're going to get from where you are now to your objectives in 5 to 10 years. You can use it for equity sharing through employee retention mechanisms, whether that's stock, phantom stock, or those types of things. You can use it as currency in acquisitions, which is super fun. If your company is worth a lot, you're an attractive buyer, and you can use that value as a negotiating tool in those dialogues. So there's lots of things that one can do with a valuation that have nothing to do with selling. And
Absolutely. Yeah, I can't stress that enough. After going through that last year, buying out a partner and knowing what our business was worth, that was kind of a wake up call for me of like, I need to know this regularly, what this is worth. I think it affects daily decisions because if we're honest, like you would never knowingly do something to intentionally decrease the value of your business. And I think we unintentionally do that. If we don't know what affects the value of your business, you end up doing things that decrease the value of it. And logic says, don't do that, right? What are the moves that make sense to continually increase the value of the business? So much to the point that this was the first year I had done this, actually, after the practice last year of it, that I provide a well broken out with comps value of my businesses to my bankers, saying, here's what third party says, like brought it in, outsourced, here's what we're worth, here's where we're sitting at. And that to me was probably the most surprising. One of them literally goes, why are you like sending this to me? What does this have to do with me? And I'm like, what does it not have to do with me? You want to work with a company that is growing in value every year. So now that they're starting to get this quarterly, it changes that relationship. They're going, man, revenue grew where you needed to. That's one thing, but how'd you tweak your valuation here? Well, knowing my numbers on the valuation of the company side affects how we buy equipment, right? It affects how we pay people, how we structure compensation packages. And still at a small business like we are, we're not huge, we're a small company. Those numbers are pretty easy to affect. And if we're not intentional about them, you can unintentionally kind of decrease your valuation. So I think it's incredibly important to know at all times.
Excellent. I mean, I think it's surprising to some folks who are so acutely focused on revenue growth on their top line. We want to grow, at the top line, at the top line, at the top line. And that's a great thing. But from a potential buyer's perspective or a lender's perspective or a partner's perspective, cash flow is king, right? I mean, revenue is great, but cash flow is spendier. And so understanding, if you're achieving top line growth, but your margins are suffering, that's going to have a direct impact on your value. If you're 100% construction and installation based, won't come as a surprise, I don't think, to many folks listening to this. Construction gets a lower multiple than maintenance. Correct. And so if your goal, again, is to create value, you can do that a number of different ways. Yes, you can grow at the top line. You can change your business mix slowly over time. I think Summit's done a great job of being super strategic about that. And you can start to kind of focus on the things that are going to move the needle, have the most impact with the least disruption.
Oh, absolutely. That's something that, again, learned so much of that last year. I think when you focus in on the details, that my thought is like, what are we left with at the end of the day? What's that number on the bottom line? How do we get there? How do I help the team understand how we get there? This is something that I've got to give them a little shout out for it that we were struggling with the last 3 years and then got this buyout done. And really it's kind of gone from there. Tim Trimmer, Professional Grounds, like this dude did this through and through a few years ago. And I could see it being in a peer group with him. The focus was no longer on top line revenue. He corrected that quickly. The focus of how are we going to do everything the best we can possibly do? How are we going to be the best in our market to increase the bottom line, take care of more people that are here, provide good jobs for the people that are here. And what unintentionally happens, and he may say it's unintentional or not, I'm not sure. That doesn't matter. It works for my point now. But what happens when you focus on those numbers is that the top line numbers started to take off as well. It's so wild to be a couple of years behind that on a smaller company and putting that exact focus on it last year, going, hey, forget about what the top line says. What are we driving to? How do we impact the lives of the people here? How do we be the best place to work? And ultimately that's going to affect the bottom line so much stronger. And then suddenly top line starts to grow as well. I think you got to focus on the bottom before you get to the top line.
Absolutely. And kind of having that team buy-in is so important. So when we were at Complete Land Sculpture earlier this year, you ask any team member there, what is our objective? And they would say, grow maintenance. Remember that? Well,
Yep.
and
I do.
maintenance
I heard it too many times. Those poor guys' genes got a
little trauma left there.
yeah, he gets to something going on there.
But I think it's helpful to be able to quantify, a percentage point improvement in margin. What that means in terms of dollars valued. I mean, it could be an eye-opening exercise. And so maybe that's the focus for next year instead of, double top line growth. Or if you're going to grow your top line double digits, which congratulations to you, just make sure that margin number doesn't.
Correct. Well, and it's the whole thing of making that small improvement that needs to happen. I think it's, 1% a week is over 60% improvement over the year. It's like getting our team to realize that, like, get that little piece. Okay, now what's next week? Get that next little piece. And suddenly, the multiplying factors start to really work in your favor.
Absolutely. Absolutely. And I'm seeing more owners now that say, look, I don't want to get out anytime soon, but 10 years from now, maybe. And so kind of understanding, if the goal is to be out in 10 years, how do we help you build a plan that will get to a value that you want in 10 years? And that starts with knowing where you are.
Oh, absolutely. You said it well.
Yeah. So we've talked about a lot here, Jonathan. What would you kind of highlight as your kind of 3 key things to focus on for business owners who may be concerned about financial health or what their company is worth? How can we make this practical?
Man, that's a lot. There's a lot to focus on for sure. But I think there's a few pieces. So speaking specifically to the financial side, it really is just knowing your numbers. I think if you're at all vague, if you think you're lacking clarity as an owner and what's going on financially with your business, I promise you everyone around you is also lacking clarity. So that's my pace that I look at it. If I'm digging into something in our books, I'm like, man, why are we at where we're at? Turns out that's probably something I need to bring up in our leadership team meeting. That's something that we all need to dig into, because if I'm at all missing on it and unclear, I guarantee many others around me are unclear of it. And I think the other end of that is just asking our team, do you understand how this happened? Do you understand why we're at where we're at? Whether that's a good thing or a bad thing, I think the question should be the same. It doesn't matter if it's, down 3% this month. Okay, how did that happen? Or if we're up 3% this month, okay, how did that happen? The question's the same. What caused that result? How do we get there? And then I think kind of probably the third thing of it, which is the final one, is really just pacing off our people here. What do they understand? What do they see? What is their fulfillment like at work? How does that play into where we're at financially as a company? I think if they fully understand their build at work and what they're doing, and they understand the collective push that we're making towards financial stability, they understand that that's how we grow people, how we take care of people. We cannot impact lives here without being financially stable. So I think being good stewards, that's where my faith comes into this as well, is like, I've got to be a good steward of what I'm entrusted with here, to make sure that if my bigger picture is to grow people, empower people, and grow a great team and impact lives here, financially, we got to be aware. We have to be strong. We have to be stable, because nobody wants to work for a company that they're unaware of if the company is healthy or not. I think our team needs to know when we're healthy and when we're unhealthy. There's a time to, kind of push down and get it done. And then another time to step back and go, hey, good job. Let's celebrate a little bit. Let's have some fun with this. So I think really pacing off the team and understanding what they see, how they understand it, to know that they have a future here because we are being financially wise in the decisions we're making. And we're really a stable company.
Absolutely. I would echo that and just say it's super important for owners to kind of lead by example. So job number 1 is kind of digging in and, getting more fluent with your own numbers as step 1. And then as it relates to your team and kind of keying off of their abilities, I would say start with one or two kind of key focuses on the financial side. They're not going to understand the concept necessarily of overhead, but they do understand gross margin and they do understand hours. And so kind of focusing on things that resonate with your team as ways to your financial health and ultimately your body. So if you understand your numbers and you help your team have a better understanding, and I guess the third thing that I would add is just kind of looking at this with some regularity. It's not a one and done kind of deal. You don't go to the gym one time and then walk out a killer bod. You kind of have to stay after it,
Oh, for sure. I mean, we've got to stay. It's got to stay front of mind. And I think we may get lost sometimes as business owners. And how are we tracking that? How are we making it visible? I would say the only wrong way of that is not doing it at all. Right? Like just figure out a way. Ask your team, whether that's metrics, scoreboards, whatever it is. Doesn't matter what software you're built in. That does not matter. Ask them how to get it to where they understand. Like you said, for some, they just need to understand man hours. For others, it's gross margin. For others, it's net margin. Whatever it is, let's get that information clear, distilled down in front of them in such a way that they have access to it at all times. That's a huge thing for us. We have a scoreboard that anyone can pull up at any time within the support team, and they can see exactly where we are at by division, by overtime hours, by regular labor hours, whatever it may be. They can see where we're at. So I think making that accessible all the time, that they fully understand where we're at, and really just asking. If you feel like it's not connecting, it's probably not connecting. So asking them, how to make this more attainable? How can I make this more understandable in a way that is going to allow you to make better decisions and allow you to be more fulfilled in what you're doing for work?
Progress, not perfection, and ignorance is not bliss.
It is literally never bliss.
Well, Jonathan, this has been a great Roots of Success podcast today with you. Really appreciate you joining us. If you're interested, we have other podcast episodes that you can plug into. Feel free to reach out to anybody in the McFarland Stanford team if you have questions about anything covered today or other things that we provide. Thank you, Jonathan. This was awesome.
Yes, thank you for having me. I enjoy it. Thank you for all the help over all the years working together. It really has been a pleasure, and I can't recommend the services and expertise enough. So thank you.
Thanks.
Thank you for listening to this episode of Roots of Success, brought to you by the subject matter experts at McFarland Stanford. Have a question you want our coaches to tackle in a future episode? You could submit that at mcfarlandstanford.com/podcast. And to find more helpful content from McFarland Stanford, follow us on X, LinkedIn, Instagram, and Facebook. If this or any of our episodes have piqued your interest in ACE peer groups, we encourage you to join us at ACE Discovery. Just check out the events tab at mcfarlandstanford.com. This is Jason New, co-founder and principal at McFarland Stanford. We'll see you next time.